Welcome to my YouTube channel, okay, where I give you a weekly update on what I think the market's going to do. All right, let's talk about the market. Again, if we look, this is a draw line right across here. This was the dot-com crash. This was the housing crash. And this guy was ready to come down like this. And that was going to be our third crash right here, called our QE crash, okay? But, and each one of them crashed for the same reason, because eventually you run out of buyers. We have so much debt, they can't, and all of a sudden they can't sell anything because nobody's buying stuff because of the debt. So what they do is they start lowering their prices. And when you lower prices, you get rid of employees, and that means the unemployment rate goes up, and that's what caused this crash here. Same thing with the housing crash, right? All of a sudden, nobody's buying housing anymore. People got laid off, the furniture factories, everything else, bam. This year, there was never any, there was no, this year was a dot-com rally. This was a housing rally. This was no rally. There was nothing there to rally. So they made one up, and they made that, they called it QE. And so they did QE1, QE2, twist, and then QE3. And that's what brought this up from this point right here. They did QE1, they did QE2, they did the twist, then they did QE3, and they stopped. Then when the market started to pull back here, they stopped it, and then they did all what we call stock buybacks. Okay, and stock buybacks have been going on since 2012, since the first one, and we had this big move all the way up here. Then everything stopped about 16 months ago, and everything just went sideways, okay? Went sideways until we broke out. And we broke out because what happened? When we broke out, because we had two things going on. We had the Brexit sell-off, and I'll show you what happened there in a second. We had what we call the Brexit sell-off, and that simply, okay, was this right here. Was the S&P, I'll show you here, bring on my chart, SPY. Okay, here you go. Okay, and we take it, and let's bring it back a little bit, right here. Okay, so what happened is we had the sell-off right here, the Brexit sell-off. Everybody thought the market was going to go down. The shorts came in real heavy on Wall Street, loaded up on shorting, and then, of course, that didn't happen because Aunt B came in and stopped it from going down. She manipulated it so it wouldn't go down anymore. How'd she do that? She prints up money. She goes in and buys the 10-year treasuries. That means that all the countries who buy our treasuries, which means they're buying our debt, instead they buy this stock market to push the market up, see, against them. Anybody's shorting. So everybody had to buy their short positions back. Then we had a pullback, and then they decided, okay, let's move the market. Employees, the employment number came out in May of 36,000. They adjusted down to 11,000, and then 4 weeks later, they said they had 286,000 new jobs. I can sell you a bridge. And then that's it. It stopped. And now it broke out, made just a little high, and every day up here, it's just doing nothing. So what's going on now? Well, what's going on now is money is leaving. Okay, why? Because the multiple is too high. What's that mean? The value they're giving going forward, meaning they're anticipating the net earnings or the net profits of the company at a 19 multiple. That is insane, okay? Right now, we have our fifth quarter of negative earnings, and they're telling us we're going to have positive earnings going forward. No way. So, and the other problem they got is not only that the multiple is too high, the value they put on the stock market going forward, but we have a 10-year treasury that's at 1.5. When you got a 10-year treasury at 1.5, you can't have a multiple of 19. It's too high. So that doesn't make sense. So what are they going to do? Well, this is the election year, so they got to finish this. They got to finish, make sure that Hillary gets elected. So what they're going to do is this. See right here? They're going to do that, duplicate it right here, like that. Okay, between now and November. So that's what we're waiting for, because if they don't, okay, this market will be in more of a severe crash, okay, than we had back here. Okay, the market would, if they don't come in and support it with a new quantitative easing, okay, this market will go down about 20%, 30%. So they can't have that happen because they need to have Hillary win this election. And the only thing that's going to make her win over Trump is a good stock market, because people believe the stock market's up because of what Obama has done, and Hillary's going to take his position. And people don't understand the stock market. The market's not up because of what he did. Okay, the stock market is up because of manipulation, because we keep on giving companies 0% interest money to buy their own stocks back. So instead of plowing money into their companies to build their company, to give people, employees, new raises, to open up, training programs, they plow it in to buy their own shares to keep pushing the stock market up of their company, because the company's doing so poorly and they don't want it to reflect in the stock value. So they rig the market to go up, which gives us a great opportunity, especially when it's green. All you got to know using this chart, when it turns green, you buy. When it turns red, you sell right here. Turned red, you sold. It was right. Turned green, we bought. Back here, it was red, right? Then all of a sudden turned green, we bought. Turned red, we sold, bought, sold. So easy. So we are up here now waiting for something to happen. Now, because we're going to August, and if you remember on the S&P last August, we had this 14% drop last August right over here. And it was because of China. See right here, we had that 14% drop. Now remember, this is interesting. We dropped 14% because China, they announced they're manipulating their currency. We already knew that. But here, which was interesting, the Brexit, that's big news. That should have came all the way down here. But they cut it off. They manipulated because they couldn't have that happen, because the election's coming and Hillary, they got to make president. So what we're going to do now is just do some stocks. All we can do while we're stuck up in this area here, and here's the problem why we're stuck up there. You've heard the term that you buy stocks when there's worry. You climb the wall of worry. Well, see the VIX index here? That's a fear meter. If you go back here in time, back to last October, everybody was fearful. That's why stocks were down here. Stocks were low. And that's the beautiful thing. That's when you buy. When everybody's fearful of buying, that's because the market's discounted. That's where you buy. When the market is up here where it is now, and the fear is down here, nobody's fearful, that means that nobody's going to sell their stocks. Because why? Why would they sell their position? They don't think the stock market can go down again. And, because there's no fear, the big guys, the institutions that move the stock up, they know better not to buy. So we're in a standoff. So we have to get, and earnings are not doing it. Earnings are not doing it. Okay, they thought, well, earnings would move it. No, earnings are still negative. When you keep hearing, they say, oh, we beat estimates. We beat our estimates by 4 cents. They lowered the bar so low, and they beat their own estimates. It's a game. You got to have net profits, and that's not happening. So it's all going to be driven by, once again, a stimulus, which is going to be QE4, which is going to make gold go up. Now, gold's having a real problem because gold, we got the dollar that's going against us now. Okay, so the weird thing is we got the market up, and we also have the dollar up right here. So you got the market up and you got the dollar. That very rarely happens. You got gold up, the dollar up, market up. Okay, and there you are. There's the dollar right here. So you got the dollar, that big move. In fact, when you look at the dollar, we've had a 20% rally in the dollar right here. Big 20% rally. Now it's been going sideways here, see? But that was a big 20% rally. So that kills all the multinational companies, okay? So right now, the dollar is too high. You got to get the dollar to come down to push up your gold stocks, okay? Like your gold stocks like GDX, or your gold stocks like AU, or your copper like FCX, okay? FCX right here, see it? You got to have gold, dollar coming down to move up, copper to move up, silver to move up, anything, any metal. It's not happening. Here's GG. Dollar's too high. It's not helping push up GG. And then you got the same problem with oils. Oils are coming down, and anything related to oil, like TSO or these are refiners, they're all coming down. Why? They're not. I mean, they're not breaking out and running hard. Why? Because the dollar is too high. Again, just always remember with the market, when you have no fear in the market, that's telling you that nobody's going to sell their stocks, but nobody's going to buy their stocks either. Okay, so we're at a standoff until we get QE, and I'm betting they're going to do QE in August. Okay, so I hope that explains where the market is today. And again, your golds, your oils, your golds, you need the dollar to go down for them to go up. I mean, it's that simple, okay? And it's not happening, so be patient, okay? It's still, remember, it's not a stock market anymore. It's a market for individual stocks, and that's why you should join my gang. And if you're busy, look, just get the color-coded chart. When it's red, you sell. When it's green, you buy. So if you bought here it was red, turned green, you bought. Okay, that's simple. Green, you buy. Green, you buy. Red, you sell. All right, I will see you on the charts.